Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be looking at Canadian National Railway stock, ticker CNI. This one came in by request down in the comment section of one of my other videos. If you have a request you'd like me to take a look at, put it down in the comments. I'll get the ticker up on the whiteboard, or up on the chalkboard behind me. I used to have a whiteboard, and eventually I'll make a video. As always, this is not individual investing advice. This is just how I analyze stocks. Okay, so Canadian National Railway. So the first thing I always like to check is the historical earnings cyclicality, fluctuations, patterns, whatever. And these guys look pretty good, right? I mean, generally speaking, earnings per share, which is this dark green shaded area, have steadily risen over the past 20 years. They are experiencing a bit of a decline this year, so let's shorten up the fast graph here. Let's see, what do we care about back here? Yeah, we'll keep it right here for now. I do actually want to see what this decline looks like right now. 10%. So we had a flat year and then a 10% decline in earnings. Overall, since the Great Recession, earnings growth has been about 8% per year. If we widen out to this entire period, it's been about 9% per year. And then in terms of earnings declines, they fell about 12% during the Great Recession. Worth noting, though, I think that the PE went down to 10. I'm not sure what it's at right now. Let's see, 20, right? Now that implies that if you have a recession that's similar to this, the stock could fall another 50%, right? In order to get the same kind of scary valuation that we had back here. That should be kind of in someone's mind whenever they think something might look cheap because the stock price has fallen. Don't know how much it has fallen yet. I'll just go off this more recent peak. It looks like it was a little higher before. Down about 25%, we'll call it off the high. So down about 25%, but still a pretty high valuation. If we think there could be a recession, we can look at this one too. I do have a 25% off affiliate link for Fast Graphs down in the description, and they have free trials if you want to check that out. You can see how easy it is to look through, especially these basic earnings patterns. So on that quick March 2020 decline, it got down to a 15 PE. And the earnings weren't fluctuating too much. They did eventually fall a little bit, and they are down now. So, that means that, if earnings don't fall a lot more, that it's not super cyclical, basically, that the earnings don't fluctuate too much. So those PEs are probably roughly correct, even though earnings are down a little bit. Like if earnings were up that 10%, well, the stock was almost trading at the same price here. We can see it was almost the same PE, right? So it was a 19 PE around a similar price when earnings were a little bit higher. Now it's a 20 PE because earnings have fallen, right? Yeah. Okay. So we have relatively rising earnings, very modest, I would say, earnings fluctuations and cyclicality, but the stock price, now I like to find the peak PEs if I can. Peak PE, we'll call it 18 in 2007. Let's see how much it fell total. We'll call it 50% off the high. So even though earnings only fell 12%, starting at an 18 PE ratio as the peak PE, the stock price fell 50%. Okay, now what I'm trying to do is establish just a general framework to think about how has the market valued this in the past? How does that relate maybe to what's happening right now? Because the peak PE is important, because if this peak PE is, we'll call it 18, and it fell 50% off an 18 PE, right? Then if the peak PE over here is much higher, which it is, I mean a 24 or a 25, let's see what it was up here, 28, right? So 28 is 50% higher PE than the peak PE before the Great Recession, right? And so what that can do is when you get these 25% declines, well, 25% seems like a lot. It's like you look at the stock, oh, it's down. Maybe it's a deal, right? That's kind of how people think. But when you consider that the peak PE was 50% higher than before the Great Recession and the stock still fell 50% back then, now we can think, okay, we're just now getting like into the PE range of where it was at the peak before the Great Recession. So what that can do, you know, you can do it mathematically or just kind of like mentally, is really probably what a rational investor could do, most other things being equal here, is say, you know, yeah, the stock's down 25%, but that doesn't really mean anything because it's just now getting to where it was at the peak of the last cycle. It looks like it has traded at these expensive valuations before. Okay, so even this little peak here was like a 20, we'll call it a 24 PE, and railroads actually traded down. I should have bought a couple of them at this point, and I barely missed a couple, Union Pacific and specifically. So I remember this because these guys weren't the only ones that traded down. So even during this little mini decline, they were down like 35%. And I think Union Pacific was down 50. Let me look, actually. I always remember the ones. Is it UNP, probably? I did have requests to look at all the railroads. That's still on my board. But we'll do a little mini. So we'll see how good my memory is. This is when I first started studying cyclicals. So this would have been a 50%. I can probably look up here and see it. 122. I think I was waiting for a 50% decline, which would have been $61, and it got down. It got down deeper than that, I think. Let's see. This is what happens when I get sidetracked. No, it got down to 68. So it didn't quite get all the way down to that 50% I was looking at. Yeah, I got down about 45%. That's why I missed it. But that's okay. I mean, when you get them, I bought like 4 doubles that month that turned out to be doubles. So it's not that I missed everything, and I was just still learning how to do, still developing the strategy. So, okay, back on task here. So because earnings aren't super cyclical, we kind of have things in context here, but we want to do a valuation, and we can use earnings for the valuation. I just want to keep in mind that the 25% decline that's happened right now is just kind of getting the stock back to like previous peaks range. Okay. Where was it going into the pandemic? 21, like right where it's at now, right? So it's at a similar valuation it was in early 2020, in 2014, and in 2007, right? Right in that kind of low 20 PE range. So we could kind of think of this as potentially like a peak, right? Okay. Now we're going to get into the time until payback valuation. So the idea here is, I don't remember exactly what time frame I used because I do track this one normally. Okay, so the earnings growth here is at 5%. I think mine's actually a little higher. It's kind of unusual, but it does happen sometimes. And this is looking forward to 2025's $5.58 in earnings. So the idea here is if you paid $100 for Canadian National Railway, how long would it take to earn $100 back from earnings? I'm also going to assume we buy their debt, so we're going to be using the total enterprise value here. What I do is I look at how much of a percentage higher the total enterprise value is than the market cap, and then I add that to the stock price. Or I multiply the stock price by the same percentage. I think this is like 24% or something. I just looked at it a second ago. Okay. So we're going to buy the company for the total enterprise value. And when we do that, we pay, instead of $102 a share, we're looking at $127.08 a share. I'm going to assume earnings grow at 6.16% instead of that 5% that we saw in the fast graph. Maybe because I used a slightly different time frame the last time I calculated their earnings growth, or maybe they just recently lowered these forward earnings. I'm not sure, but this is right in the right range. I think that's a fair Oh, it could be currency. It's probably currency, honestly. But this is right in the range. Okay, so assume we earn next year's earnings $5.58 a share, and we pay $100 for the company. That gives us an earnings yield of 4.39. So for every $100 you spent on the company, or part of the company you bought, you would earn $4.39 on that $100. And the spreadsheet here calculates how long it would take to earn your money, or how your money would grow, and how long it would take to earn $100 back if you collected it. So we get that 439 plus the growth, 6.16%. You collect that, you put it in the bank. You get next year you get $4.95. Next year you get $5.25, on and on. How long would it take for that to add up to $100? An additional 100 on top of your 100. And I have that coming in at 15 years right now. Okay? So this is right where the S&P 500 is, where the average S&P 500 stock is at. So I think this all looks pretty reasonable. I'm using 1 year forward earnings basically, which is what the market usually does. This all looks pretty like plain, like vanilla valuation stuff. I didn't calculate when it would be a buy, so I will do that for you right now. So I usually want this to be 10-year payback time, so you would earn your money back from the earnings within 10 years. So let's try some prices here and see what would get us there. I'm going to say about 60 is my guess. Oh man, so good. You'd think I'd do this all day for a living. We're going to go up a little bit until we get to 11, and we'll get to the kind of top end of that. There we go. So about $63 a share would be where a person could look to buy with some margin of safety and able to, earn your money back in a decent amount of time as the owner of a business. The biggest factor here is probably going to be in terms of how this could change, would be what earnings do this year. So you could keep an eye on that. And I think they're expected to grow quite a bit. Yeah, they're expected to grow 13%. So I would say that's a realistic but optimistic. I mean, I'm not an expert on this industry at all, but just previous pattern. Well, you can look at 2020. Like we had a little decline, kind of a rough year, and then the next year they came back 12%. So we kind of see the same thing. We have a little bit of a couple rough years of growth, and then we could expect maybe, but I don't know if they will or not. Who knows with like tariffs and all that stuff. So, but that number will be what will probably, if that number stays the same and the stock price falls a lot, that's when you would want to buy. Or it stays roughly the same. That's when it would kind of be a buy. Now, if earnings miss, then that will lower the buy price even lower. Okay, if you're interested in stock picks, I have one per week over on Patreon at the $25 a month tier level. I started that back in October. It's doing really well. People really like it, so check that out. I also have a free tier on Patreon where I post all the same videos that I have here on YouTube. If you don't want to miss anything, you just want to keep an eye out on what's going on over on Patreon, and you don't want to rely on the YouTube algorithm to find me and find out when my videos come out, which is daily and maybe more than daily here soon. It just kind of depends. I'm trying to make more videos because I have so many requests that I'm behind. And so thanks for watching, and I'll see everybody later.